Welcome to Outlook 2022. It is Tuesday, January 25th. I'm Bob Simpson, Vice President, Portfolio Strategy for Wealth Stewards, and I will be your host this evening. I'm joined by Paul Tyers, Managing Director and Portfolio Manager. When we planned this evening, financial markets were completing one of the strongest years on record. The S&P 500 closed 2021 with a gain of 28.7%, and the TSX Composite was up 25%, including dividends. Unfortunately, this changed as the calendar rolled over to a new year, and markets have been off to a rocky start. The S&P 500 has dropped almost 9%, and the TSX has held relatively well at around down 3%. So I think there's no better time than to bring together our diversified panel of specialists. Ken Gronbach is from Bonita Springs, Florida, and he's one of our favorite sources of demographic information as we try to stay on top of demographic trends that drive consumer spending and workforce capabilities, which we believe are key drivers of success for many companies. Ken is the author of The Age Curve, How to Profit from the Coming Demographic Storm, and Upside, Profiting from the Profound Demographic Shifts Ahead. Now, before we begin tonight's presentation, it is set up to leave time at the end for you to ask questions to be directly answered by our panelists. Please use the Q&A button on your Zoom control panel to post your questions. We will try to address as many as possible. Please don't be intimidated. There are really no bad questions. Secondly, just a reminder to our panelists that our audience is comprised of non-financial people who may be business owners, accountants, doctors, physiotherapists, the couple next door, or retired people. So let's try to avoid industry jargon the best we can, and let's try to keep it simple so our audience will enjoy listening and learning this evening. But thank you to everyone for joining us this evening. So you've seen the bios that we posted just as we started out, so we're not going to spend a lot of time doing that, but I'm going to jump right in with Ken Gronbach. So Ken, number one, thank you for joining the roundtable.
Thank you.
I first ran across you when I read The Age Curve that was published back in 2008, so somewhere around 14 years ago. And personally, I'm a big demographics fan. I bought a cottage back in 1991 because Canadian demographer Dr. David Foote, who wrote Boom, Bust, and Echo, told a session that I attended that the oldest boomer was 43, and that was the age at when people buy their first recreational property. So I went out that weekend, bought a cottage, and we all know what's happened to cottage property since. So let's start the discussion, Ken, by looking at what is the study of demographics and how can demographics help us to make the shift from uncertainty and unpredictability to certainty and predictability, to use some of your terms.
Yeah. Well, first of all, demographics is very, very simple. And you don't have to worry about me using sophisticated language because I don't know any. But demographics is simply live births, immigration, migration, and deaths. And once you understand critical mass of given generations, you can make forecasts based on what they are going to consume. Probably the most important question anyone can ask themselves if they are selling anything, a product or a service or whatever, is how big is my end user market? And is my end user market getting bigger or smaller? Because if my end user market is getting bigger, then I have enormous opportunity. And it's not going to be a cakewalk, it never is, but at least you can plan for a larger market. And if my market's getting smaller, I got to look elsewhere for something, look to a different market, because that will dictate everything. So understanding the size of your market is demographics. And all you have to do is look at wherever you are, wherever your market is geographically, and where are the bodies, and then go fishing where the fish are. Does that answer your question?
Yeah, I think so. So, one of the things that we look for in companies is companies that have strong earnings growth. So companies that are in expanding markets will have stronger earnings than companies who have declining earnings, right?
Exactly.
Right. And that's the key driver, as I think we'll hear Nick Griffin say later, That's the key driver of stock.
Well, you just said it when you talked about vacation homes. Let me give you a simpler one. Eyeglasses. Do you know what drives the sale of eyeglasses? It's a phenomenon called presbyopia. And presbyopia happens normally between 40 years old and 45 years old. The largest generation in the history of the United States, Generation Y millennials born 1985 to 2004, are currently 18 to 37 years old. So they're headed right at optometrics, right at it. So what's going to happen to all the folks that sell eyeglasses? They're going to get hit by a tsunami. And that's very similar to what you're talking about with your vacation home. Once you understand what your market is, who buys what you have, and then you look down the parade or the time continuum and see what's headed your way, it makes all the difference in the world.
So if we look at demographics, there are really two major demographic groups in North America right now. Is that right?
That's right. And that's the baby boomers. The baby boomers are currently 58 to 77. And essentially their kids, Generation Y millennials, born 1985 to 2004, and they're 18 to 37. The babies of the baby boomers are almost 10 million stronger than the baby boomers. So whatever happened with the baby boomers throughout the economy through the 60s and 70s and 80s is going to happen all over again. Yeah, it's a very exciting time.
Yeah, it is. So what we saw back when we were kids, right? When we were getting out of university and we moved, personally, I moved into Toronto, tried to find a place to live. Right. I was competing with all the baby boomers. I couldn't find a place to live, hard to find a job, all of that kind of thing. Is that what today's millennials are going through?
Look at it this way, and I'm just going to give you the numbers in the States, okay? Because it works for Canada and the United States. There's 330 million people in the United States. You have 80 million baby boomers that haven't died because they don't have dying on their punch list, and 88 million of their kids, essentially, for the most part, are still living under one roof. The kids are moving out. There aren't enough houses. They're simply, unless the kids are going to live in their cars, there simply aren't enough houses. By our calculations, over the course of their generation, we're 25 million housing units short of our needs. And it's overwhelming. You experience not being able to find a place to live. Well, that's exactly what's happening now, but it's also happening here in Florida. It's like it's overwhelming because we not only have that, but we have all of the baby boomers coming down to where it's warm. So we're watching housing values go through the roof, and we're watching multifamily housing being built at all levels.
So Ken, when people talk about a real estate bubble, they don't know what they're talking about.
No, it's not. That's nonsense. No, it won't be a real estate bubble because real estate will be strong for 10 or 15 years and probably beyond that.
Right.
10 or 15 years.
Now, are we going to see a transition? We're going to see a transition from baby boomers as they sort of check out or downsize.
Be careful. Baby boomers aren't going to check out.
We're not going to check
I understand what you're saying. Boy, let me paint that picture for you, okay? Because I live in South Florida, and you see it in South Florida happening all around you, and it makes you crazy. Baby boomers are currently 58 to 77 years old. The body breaks. Human body breaks at 75. That's when most of the things start to go south. What do we have down here? There are medical structures after medical structures and specialties being built and built and built. You're going to see what the baby boomers are going to cause to happen is they have the critical mass, they have the money, and they have the motivation to throw money, massive amounts of money at healthcare. So healthcare is going to go through the roof and stay there for 10, 15, 20 years.
Right. So the fact that healthcare stocks are down 10% right now might be a buying opportunity.
Yeah, it'd be an excellent opportunity because I'm going to buy tomorrow. And I'm not kidding. I'm doing it tomorrow.
Yeah. No, and that's exactly what we see. So healthcare is where, if we're looking at trends right now, healthcare is a baby boomer trend. Yeah. What is a millennial trend? What trends should we look for?
Two things. I have two daughters. One's 26 and one's 29. They moved out of our house. We're empty nesters now. 4 or 5 years ago. When they left, they didn't take the vacuum cleaner, they didn't take the dish soap, they didn't take the lawnmower, they didn't take the snow blower. They bought their own. What you're going to see is consumerism on the part of the largest generation ever born in the United States at a level we don't understand.
Mm-hmm.
So consumerism. Now, and add to that housing, it's awesome.
Right. So whether it's cars, whether it's baby furniture, whether it's beer,
yeah,
they're going to be buying.
Automobiles. Now, this is very interesting. Who buys the most cars? Most cars are bought by men and women between the age of 40 and 45. That's when they're carting the kids around. That's when they need 2 cars in the family. And the Generation Y millennials are headed right out. The largest generation in the history of our nation is headed right at automobiles. What do you think is going to happen to cars?
Mm-hmm.
It's going to be awesome. It really is.
Yeah. So if you're putting a up arrow, down arrow, sideways arrow on the stock market over the next 10 years, straight up.
Yeah.
Straight up.
I don't want to listen. I'm not an expert like you. I really am not. But I'm just telling you that I believe that we're headed for an economy in North America that we don't understand, that we really do not understand. And we are so superior in the way that our country is structured demographically, so superior to Europe, Eastern Europe, Russia, Southeast Asia, India, Japan, China, so superior that things are really going to change here, and they're going to change for the better. Industry is coming back to the United States. Why? Because China, with their one-child-only policy, eliminated their labor force. Clever boys.
Mm-hmm. Yep. And with the 88 million millennials, we're going to have a labor force in the U.S.
We're going to have the best labor force we've ever had. We just got to get past calling them names.
Yeah. Okay. That's awesome. So we're going to move on to Nick Griffin. Nick is founding partner and chief investment officer at Monroe Partners out of Melbourne, Australia. Now, Nick is a rare breed of investment manager in that, to use a hockey term, he plays both offense and defense. When times are good, he invests to optimize performance, but when times are bad, his firm takes defensive action to protect investor assets. Now, he's a world leader, in our opinion, on analyzing trends and taking decisive action. But so Nick, before we get started, thank you for joining us from down under. And before we talk about trends, did you watch the Denis Shapovalov Nadal match last night?
I missed that one. I watched the Monfils and the Italian guy, and I actually don't know how it finished. It was going to a 5th set when I went to bed. But the Shapovalov game, he lost, unfortunately, in 5.
He did,
Very
yeah.
unlucky.
And who are you cheering for tonight between Felix and Zverev?
Oh, look, to be fair, we're here in Australia, we're very sparse on good tennis players at the moment, so we're all supporting Ash Barty in the women's. Right. And she's our world number 1, and she's the one. Not following the men's draws closely. Right.
I watched a little bit of that Aussie who won the wheelchair.
Yes.
Thing, and he's an amazing story out of Australia.
Yeah, and he got it's actually, well, as we continue on our side here, it is Australia Day today here in Australia, and he was announced Australian of the Year last night. So he's
okay. So let's jump into equity markets. So you started the year, you've heard Ken Gronbach's discussion about demographics, and we started the year on a very soft note. Should we expect this to continue, or do we view this as a buying opportunity?
Oh, look, ultimately, it's a buying opportunity, definitely, because, earnings growth will drive stock prices in the long run, and growth will continue. And I'm sure we'll talk about some trends. But we do need to recognize that we are in this period of time where the Fed is moving to try and squash inflation. That's going to cause volatility. Previous Feds have talked about moving at the speed that paint dries, and this one's not. So you have to respect that a little bit and just be a little bit conservative for a while. But ultimately, it's a buying opportunity. Unfortunately, I just can't tell you exactly where it's a buying opportunity, but it will be a buying opportunity. And what you're seeing is a lot of excess come out of the market at the moment. That's ultimately a good thing. I think a lot of us were concerned about it last year. It's now coming out. It came out of the speculative stuff really early, the SPACs, the meme stocks, the really high multiple tech stocks, and then it's coming out of and then it started to come out of the big cap tech stocks. I suppose that's understandable also. And then it's coming out of the broader index. That's means we're closer to the end than the beginning. But I just can't tell you when it's going to stop. But we'll find out a lot more tonight after the Fed speaks. But I suspect they're going to be on this path for at least 1 or 2 meetings.
Right. So unlike a demographer who counts people and predicts the future, it's much more difficult to predict the future of financial markets.
I think what everyone on the call needs to sort of get their head around, and I know this is a little bit difficult when it's volatile, is ultimately, stocks follow earnings growth over time. So if you plot Microsoft's earnings growth over time, its share price basically perfectly follows it on a 10-year view. Mm-hmm. And in between, it'll go above and below and above and below and above and below as all these, people get overexcited and then they get too pessimistic and then they get overexcited and they get too pessimistic. And we all have friends like this, and we all have people that we know like this. And that's just what's happening at the moment. And we're just moving from maybe too excited to too pessimistic. Mm-hmm. But the trend is still the same. On any 3 to 5 year view, Microsoft earnings will grow from here. The PE multiple is less than 30 times earnings. Mm-hmm. That means it's roughly 3.5% free cash flow yield or earnings yield. And you're not going to get that in the bank. And the 3.5% will grow at 10% per annum for quite a long time. So it's clearly a vastly superior investment than cash. But we are just in that period where maybe the pendulum went too far this way and it goes back the other way. But ultimately, the trend will endure. And I just can't tell you where that point is, I'm afraid, because you don't know how much speculation there is. But you know that the Fed wants the speculation to stop, so they're going to keep pushing here for a little while, I suspect.
Okay, turn over to Paul Tyers.
Yeah, Nick. So one of the trends that I've heard you speak about is climate change.
Yep.
And obviously, leaders, government leaders in particular, have this on their agenda, and they've made commitments. How do you see that influencing the investment landscape in the future?
Yeah, so thank you, Paul. That's a great question. So let's take the short-term stuff out of it, because it's ultimately not going to help you make money in the long run. And so if you're investing, what you're generally trying to do, the same as demographics, is find big structural changes. Those big structural changes will generally equal earnings growth, and earnings growth will equal share price growth. It's pretty simple. And provided you don't pay too much for it, that'll generally work out over time. We think we've passed a tipping point in decarbonizing the economy. So we think we are now going to attempt to decarbonize the planet. It's going to cost somewhere between $30 and $50 trillion to do it. And that's $30 and $50 trillion of revenue for the companies that will enable those carbon solutions. So this is a big structural shift. It's a big structural growth shift, and you can invest in it. And you can look at things like clean transport, which is pretty obvious. And, obviously that's what's driven Tesla. But right now the valuation is probably too high. But you can also look at renewable energy. You can even look at things like energy efficiency. So the ability for buildings to be more cleaner, just how do you heat your home, for instance, will have to change. And then lastly, you can look at recycling solutions, so circular economy packaging solutions. Those would be the 3 big areas we're focused on. But we think, this is the biggest opportunity we've seen since the internet came along, because the numbers are just so big, and I suppose the impetus to do it is now just accelerating.
Well, it seems to me that in the last 5 years, we started to hear the word trillion a lot more commonly.
Yeah.
And it just shows the multiplier effect of some of these big major projects. Something we didn't tee up ahead of time, but how do you just see carbon credits fitting into this trading? Do you have any view on that?
Yeah, we do. So okay, there's a big trend that covers governments, it covers corporates, and it covers individuals. Okay, so at the individual level, you'll buy the aluminium can drink as opposed to the plastic bottle, or you might buy an electric car. The corporate level, you're setting a net zero target, and you're going to try and get there, and credits will help you, but you don't really need them. You're going to do it because it's the right thing to do. The carbon credits fit into the government bit, and so the government bit is literally just governments providing incentives for people to decarbonize. And when they turn up at these conferences like COP26 in Glasgow, they commit to targets that they have to do. and then they have to go back to Canada or Australia or the United States and enact policies. And one of those policies is carbon credits. It's worked well in Europe, but it's definitely been bumpy. It can work. It's worked very well in California as well. And I suspect you'll see the same thing. I know you're going to do it in Canada as well with the low cost fuel standard. And it's very supportive of renewable energy and renewable diesel, for instance.
Yeah. So Nick, we like working with managers. It's interesting to hear from somebody like yourself, because most of the managers that we work with are all local. So I think you have a different perspective, but you have a couple of great slides, and I know we're not doing a slideshow right now, that show all of the major trends that you see. Can you just share with us some of the trends that you see going forward over the next 10 years that we should be looking at from an investment point of view?
Yeah, so obviously, what you're trying to do is identify these structural trends, because that will equal earnings growth. That earnings growth will drive the share prices. And so the big ones we've had in the past are things like smartphones came along and went from nothing to everyone had a smartphone, and that turns Apple from 50 billion to 3 trillion. That's sort of what we're looking for. The big trends that we've seen out there in the last few years that have done very well for us, or really in the last decade, is things like the internet or internet advertising. We still think there's growth there. Things like digital payments. There's still cash in the world, unfortunately, which will slowly disappear. So the fintechs, e-commerce is still only 25% of all retail transactions, and that should probably go to 50. And the last and biggest one that everyone knows is cloud computing. We do more on software, more in the cloud. There's still a long runway there to go for. We spoke about climate. The last one I'd probably give you, just to give you one that's a bit different, is the one that we really see out there that I suppose is exciting us the most at the moment is semiconductors. I know in Canada you like your oil, and here in Australia we like our resources, and oil is exciting and it's great, but it's probably not going to be around 50 years from now, unfortunately. Semiconductors are the new oil. They effectively drive the digital economy. We now are scared of protect Taiwan like we used to protect the Middle East. And we're not really we don't concerned about protecting the Middle East anymore, because semiconductors become the most strategically important thing on the planet now, because they are the driver of all human progress. And so what you do to win as a company is you just throw silicon at the problem. More artificial intelligence, more data to effectively get better outcomes, to create better things for your customers, whether it's insurance or whether it's a delivery app or whether it's an e-commerce site. And so from that point of view, this silicon demand is just going to grow into this huge wave, or we call it the sandstorm. And the reality is there's only really a few companies in the world that can make this stuff now, and that's TSMC in Taiwan, or that's NVIDIA on the design side, or that's companies like ASML in Holland on the lithography side. And so that's sort of our next, between that and climate, are our next big mega trends that over the next 10 years we think will play out. That'll drive great earnings growth for those companies, and hopefully share price growth for them, with a few bumps along the way, as we're all used to.
Mm-hmm. That's awesome. Paul, over to you with Kate.
Well, I have one additional question for Nick, a question that's come up from the audience, and that is, how does cryptocurrency fit into the currency? You mentioned cash going away. Just any brief comments on that?
Yes. So in theory, yes, cash could go away, and in theory, okay. So let me just take a big step back. Okay. So all digital businesses do is disrupt things that are effectively high cost. And the reality, whether it's newspapers or whether it's digital advertising or whether it's, foreign exchange, a digital currency, there is a need for the planet to have a digital currency. Changing money from Canadian dollars to Australian dollars to US dollars is expensive and cumbersome. I just can't tell you which one it is. And I also can't tell you how long it's going to take to get there. And so you should, if you wanted to, you could pick a couple and take a small position, and it might work out. But also know that, when it doesn't work out, you don't have a dividend yield or a free cash flow yield or a CEO that you can talk to help you understand it. So we don't invest in cryptocurrencies. We invest in companies run by great people who are trying to solve big problems. That's how we've made money for a very long period of time. cryptocurrencies are trying to solve a big problem, but we just don't have anything tangible we can get our hands around. So we'll leave that to the clients if they want to do it. I'm not going to talk them out of it. I see the need, but it's not something we're doing.
We're very consistent with that point of view, Nick, as well. So let me just go along, and I'm going to talk to Kate MacDonald now. And Kate, last year we had the privilege of having you on this Outlook panel for 2021. And folks, if you have any questions about real estate, Kate is a great source of what's happening in real estate across Canada and frankly worldwide. She joins us from a slightly cooler location where Ken and Nick are from. She's just outside the GTA. So hopefully you're warm enough, Kate, to answer a couple questions this evening.
Always, indeed.
Good. Now, you and your partners manage one of Canada's best performing real estate investment trusts. We hear these days constant chatter that there's a real estate bubble and that prices might soon collapse. I think they're referring in part to residential real estate in the Toronto area. Are there areas that you would steer away from at current prices for the foreseeable future?
Well, great question, Paul, and such a pleasure to join you in the group today. Certainly when we look at real estate, our focus is, of course, income-producing commercial real estate, given that is the nature of assets that the REITs, the real estate investment trusts in which we invest, own. So I don't spend a lot of time thinking about or underwriting Toronto housing or housing prices in Canada more broadly, other than to say that we do think that the demographic growth, immigration, the lack of inventory and supply as it relates to housing specifically is very strongly supportive for a continuation of strong pricing. That said, are we likely to see home price appreciation in the magnitude of what we enjoyed in 2021 as homeowners? No. I do think that rising interest rates and such will likely be a factor. That being said, when we talk about real estate more broadly, we do see very strong underpinnings, which we think will continue to support commercial real estate valuations. So commercial real estate has attracted a significant investment on the behalf of global institutional investors, and we're seeing this certainly play through in real estate transaction markets. So income-producing commercial real estate certainly saw a lull in terms of deal volume or transaction activity through 2020. As COVID restrictions eased in 2021, we saw a very significant rebound in commercial real estate activity. In fact, in the U.S., commercial real estate volumes for 2021 hit over $800 billion, so nearly doubling 2020's total transaction volume, and in fact surpassing the prior peak levels of about $600 billion, which of course was reached back in 2019, being the prior peak. We did see a similar dynamic play out in Canada, where we saw record commercial real estate transaction activity in both Q3 and Q2, the earlier quarter. We don't yet have data available for total transaction activity for the full year of 21 for Canada, but it certainly looks on pace to surpass the prior peak of 2018 by a decent margin. Now, we are seeing significant influx of global capital targeting real estate. We spend a lot of time tracking institutional investor surveys or investor intention surveys to really get a sense for what the smart money is doing. And what we're seeing is these large global investors, including the world's largest pension funds and sovereign wealth funds, have continued to grow or increase their target allocations to real estate. So one of the investor surveys we pay close attention to is the Hodes Weil and Associates survey, which came out late last year. And what we saw in the survey is that again in 2022, institutional target allocations to real estate again increased, this time by 30 basis points or 0.3 percentage points to 11%. Now you think 30 basis points sounds utterly inconsequential in percentage terms, but in dollar terms, given these global investors have in excess of 13 trillion of capital under management, in dollar terms, it's quite a significant figure. And certainly we've seen as institutional investors have increased their allocations to real estate, we've seen this play through in terms of real estate private equity fundraising. So household names like Brookfield and Blackstone and the other very large real estate private equity groups have been hugely successful raising flagship real estate funds. In fact, Blackstone most notably has had tremendous success with its non-traded private REIT, Blackstone REIT or BREIT, which, as we understand, has been raising in excess of $3 billion in net inflows per month. And actually, one of my close contacts had suggested that that degree of fundraising has actually kicked into even higher gear more recently, with recent fundraising surpassing now $5 billion per month. So we are seeing certainly very strong continued demand for commercial real estate as a function of these increased institutional allocations to real estate, which has played through into very strong real estate private equity fundraising and a significant need to put capital to work. So when we look at these real estate private equity funds, we are seeing record dry capital. And that's just a function of the very strong fundraising and the fact that it is very difficult to go out and acquire real estate at scale. So real estate private equity dry capital or uncommitted, or capital that's committed but not yet deployed within these funds has now hit over $288 billion in U.S. real estate private equity funds alone. So given the amount of capital and the need to put this capital to work, we do anticipate continued very strong commercial real estate transaction volume and transaction activity and a strong bid for commercial real estate assets in the coming year.
Yeah, so Kate, if you invest in a broad range of investments in the REIT arena, what do you see as some opportunities looking forward? What are some areas of strength and what are some areas that you might be avoiding?
Well, great question, Bob. And certainly 2022 year to date has brought with it a very tough go for markets as investor concern with respect to central bank tightening, with very strong inflation prints, with concerns over the conflict in Russia and the Ukraine. There's a whole host of reasons for which we are seeing markets in the red to start the year. And unfortunately, real estate has not been immune to that market turbulence, and REITs have traded off in sympathy with broader markets. Now, what we're seeing in terms of sector valuations is actually REIT discounts to net asset value or NAV, in fact, just above a 10% discount. So we are seeing value in the real estate space broadly. That being said, in terms of where we're allocating within the space, we are seeing real opportunity in multifamily residential for many of the demographic trends that Ken spoke to earlier. Certainly housing affordability, given the very strong home price appreciation we've seen effectively across markets, has meant that the demand for affordable housing or rental housing has been even further strengthened. In particular, the Canadian apartment names, we really haven't seen the degree of occupancy recovery that we have seen in some of the other markets. So we are seeing opportunity within the Canadian space specifically. We're also seeing opportunity within seniors housing. Certainly seniors housing was right in the bullseye of the COVID pandemic, and we've seen occupancy trend lower amid a weakened demand outlook on that basis. And we also have seen significant pressure on margins. We do think that as the COVID situation normalizes, And given the very strong demographic underpinnings, that we will see an improvement or an increase in occupancy levels within seniors housing, which should drive an improved earnings profile and a re-rating within those stocks specifically. We're also seeing, I spoke to private equity or real estate private equity earlier. We are seeing very strong demand both for apartments as well as senior housing assets, specifically in Canada, where we've seen a number of trades on the seniors housing side at valuations that are on par with pre-pandemic levels, whereas many of these listed seniors housing issuers that are traded on the exchange are still trading at double-digit discounts. Now, in terms of areas that we are avoiding, we are still cautious on office. Certainly, we're all currently working from home. Omicron has only served to kick the can down the road in terms of the return of employees to offices and improved office utilization. And in that environment, given the lack of visibility with respect to occupier need for office space, we have remained quite cautious, very selective within office REITs specifically, and are very comfortably underweight office relative to our benchmarks within the funds.
Awesome. So thank you, Kate. And I'm going to turn over to Paul with Jim Murdoch.
Sure. Jim, I want to welcome you all the way from Toronto here today. And Jim, we're going to turn our minds to an area that probably is concerning a number of us, and that is, as a result of COVID, we think that I think a lot of people are thinking when the other shoe will drop when it comes to taxation. So some of the other speakers has focused on helping us make money, but hopefully this evening you can tell us about some ways to save money with potential and understand maybe some of the potential tax legislation that's ahead of us. So I guess my first question is, as a tax lawyer, we're interested in your opinion on the implications of COVID and on tax policy, particularly for high net worth Canadians.
Right. So yeah, you're going to want to make money because your government's going to be wanting it, I think is the message that a lot of us are taking. But what we have seen over the last several years is a targeted tax measures at high net worth Canadians, right? This has been politically a politically popular sell. The dirty little secret of all of those targeted tax measures is that they don't really raise revenues significantly, if at all. And what we have seen with COVID, of course, is really massive increases in government spending, all financed through deficits, that maybe it's sustainable. I'm not an economist, but the expectation is that, as you say, this shoe will drop, and that at some point governments are going to become looking to reduce deficits, pay down the debt. If that does occur, then I think what governments will have to be serious about raising tax revenues, and that's going to mean broader tax changes in and the easiest ones really are consumption taxes in terms of raising tax revenues, and those types of taxes that all Canadians at all income levels will have to participate in will actually potentially be the tools that the governments that are serious about this would have to look to. In terms of tax policy changes for high net worth Canadians, and that we're so conditioned to expecting to see because this is how governments have been playing this over the last several years. Perhaps COVID isn't really going to be that big of a driver of it. I think politics will be a driver of it, but I don't know that COVID will be a driver of it. It's even occurred to me that perhaps it might make governments more cautious about wading in with big tax changes, but remains to be seen whether my optimistic hope on that one would play out.
Bob?
And just a message to our guests this evening that we are coming to the end of the formal part of this. If you do have questions, please post them, and we'll address them. But I guess my question for you, Jim, is: are there specific areas that you anticipate that are going to be targeted in the area of policy changes?
Yeah. Well, in addition to, I guess, some of the things I've alluded to, I mean, I know there's a lot of speculation. There's been a lot of speculation about tax changes that are coming down the pipe, and maybe I'll speak to some of those. Probably the most persistent rumor that has been out there, and it's not new, is that capital gains rates would go up. There are good reasons why these rumors are out there, because in fact, from a tax policy perspective, the incentive to earn capital gains over dividend income, other sources of income, has the potential to skew certain actions that taxpayers take. And that led a lot to some of the proposals, if you remember back to Bill Morneau's 2017 private company changes that mostly ended up being killed. Those changes were driven from these actions that taxpayers can take to legitimately earn capital gains as opposed to other sources of income. And so that has led to persistent concerns that capital gains rates would go up. The government, however, has never indicated that they want a broad-based capital gains increase. And I'm beginning to think, in fact, I'm less worried about that now than I was before. Again, partly because I don't think the government is looking to a tax that they would see as potentially killing investment. And I think that would be the result of a capital gains increase. So I'm hearing less about that than I have before, perhaps ironically. The other thing that has been floated around, though, is a form of wealth tax. This would take the form of an annual levy, which would presumably be one of these sort of targeted taxes against only the high and perhaps very high net worth people. This, I understand, was studied by a team at the finance department. I don't think it's going anywhere, and I haven't heard recent rumors of it, but it I think was under consideration. There's always concern about inheritance taxes, but I don't think those are a serious concern. And Canada is fairly unique in not having a comprehensive inheritance tax. So when governments start searching around, would they look to that? But I don't know that they would, for the same reason that I talked about, in that it wouldn't be a big revenue raiser, probably. And then the other area that really is where there's the most focus on is actually taxes directed at the housing sector. And these are primarily taxes with the intent of solving the housing affordability crisis by making housing more expensive. And governments seem quite enamored of these types of taxes that I think are mostly designed, again, from a political standpoint, to make it appear that they're trying to do something. Most of these taxes to this point have been directed at non-resident owners. We are going to have a federal tax across the country on an underutilized housing in Canada. So this is coming down the pipe. And then the other thing that government tax policy is very interested is your information. And many of these taxes require ever greater reporting burdens. And we're seeing increasing requirements to disclose. Ultimately, this would be required in any sort of tax on, it's quite intrusive in terms of looking to tax underutilized housing. They need to know, well, who's using this place? How are you using it? All of these taxes tend to require ever greater disclosure and compliance obligations. So these are areas that are being targeted, and that I think we'll continue to see more action around.
So Jim, one of the things that when it comes to taxation, people like to be able to stay a step ahead of what might come down the pike. And do you have any sort of broad strategies to be proactive to maybe mitigate some of the things that broadly you've spoken about this evening?
Well, just off the top, I mean, this, I guess, goes to the last point I made. Simplification, might sound strange coming from a tax lawyer, but I'm a big fan of simplification in one's affairs if it can be done on a tax effective basis. And, the tendency for a lot of high net worth people has been to complicate affairs, usually to take advantage of one tax incentive or another. And what we see now is that some of these structures that are put in place are no longer effective. Sometimes they're just creating more and more compliance. And as we see ever greater demands for information, the complicated structures are going to create some issues for people. We have, I don't know how many people are aware, but if you have family trusts or any trusts, there was to be a requirement this taxation year to disclose all of the beneficiaries of the trust, their social insurance numbers, or their tax identification numbers anywhere in the world that they might be. I had trusts that had hundreds of people that perhaps would be covered all over the world. That law didn't get passed, but only because our parliament rarely sits. And so it's still going to be passed, and it will be in place for next year, I'm almost certain. So, when you're looking at all of these structures that we've been so keen to push for one tax advantage or another, I think we now need to step back and say, well, should we be simplifying? Because compliance is a real issue. Beyond that, it's difficult to know what's coming down the pipe. And certainly if it's broad-based tax measures, there's not a whole lot probably that you can do. I do get a lot of inquiries about immigration and going somewhere, leaving the country. And that is obviously an ultimate kind of solution for some people, but it has to be done very carefully. We do have exit taxes. We have a deemed disposition and you will pay tax on your capital gains, but in some cases it makes sense. Other strategies for now, we do look at capital gains solutions for people with private companies, and that still remains available. It's likely that there will be, if not a broad-based increase to the capital gains rate, which I think is less likely, that there will be targeted measures at some of those strategies.
Right. So I think we're going to jump into the Q&A. Thanks, Jim, and we've got a couple. Jack has been good with a number of things along the same lines, but just to jump participants for a bit. I think it's a unique opportunity to have Ken Gronbach on the call. And I'm wondering whether Nick or Kate, you have any questions that you might like to pose to a demographer today? Put you on the spot a bit.
Yeah, no hard questions, okay?
Yeah.
I'm just wondering if you can give me some details as to, like, so you mentioned the glasses thing with the Generation Y people, of Gen Y moving into the glasses area.
Yeah.
Can you get some numbers around it to try and work out how big that could be? Like, how big is the uplift, or maybe some previous examples where it did create, how big is the shift between each generation, and how much does it move things? That was the question I thought of when I was listening.
And that's a good question, because what happened with the baby boomers, we took on a client when I was in the marketing business that sold eyeglasses, and we took them from under $1 million to $15 million just in a few locations in New England. And the reason was the baby boomers were moving towards the need for glasses and developing what they call presbyopia at a rate of about 4 million per year. That's about the number of babies that are born in a block of 80 million people over 20 years, 4 million per year. So what we're going to have now is a larger generation that's aimed at that eyeglass industry, and the whole presbyopia thing between 40 and 45 is even going to be larger than that. So it can't go anywhere but up. It's impossible, or otherwise people are not going to be able to see.
Mm-hmm.
That's helpful. Thank you.
Yeah. So Kate, one of the questions that I might have for you to Ken is, are the millennials going to buy, or are they going to rent?
Is
that something, Kate, that?
No, is that the question Kate is asking?
Yeah, so I'm asking it, it's a question, I'm just putting a question in Kate's lips there. But is that something that you look at, Kate, that are we going to see do you think, Kate, that we're going to see people buying, or are they not going to be able to afford to buy homes and they're going to be renters longer term in the millennial area? And I'm just interested in both your thoughts and Ken's in that regard.
Well, certainly we have, in our discussions with the apartment REIT management teams, we do spend a lot of time understanding relative affordability of apartments relative to housing options, and also understanding trends around tenants moving out to buy homes. So what we've seen following the very rapid appreciation in home prices across a number of geographies, we did in fact see across a number of real estate portfolios a decline in move-outs to buy homes. And this is just a function of affordability. Saving up for down payments for many is a significant challenge, and that has not been eased by the significant appreciation in home prices. So we do anticipate, certainly, that tenants will stay in rental housing longer, and we are seeing that play through.
Right now, do you see, we're maybe, you're a global manager. Are you seeing areas in the United States that are in this, maybe as an area that you and Ken could discuss, but is there a particular area that people are moving into in the US that you favor real estate?
Yeah, so that's certainly in migration into the US Sunbelt states. Has been a factor in our investments in U.S. Sunbelt residential. So we have very strong positions in Tricon Residential, a U.S. single-family rental REIT, as well as Camden Properties, a multi-res apartment REIT, and a whole host of others. And that's really all predicated on population migration and demographic trends, specifically demographics as it relates to single-family rental housing, because as millennials and the population ages out of wanting to live in a rental apartment because they've gotten married and they've had children, they want more space. And so this is driving very strong demand for U.S. single-family rental housing, which is a nascent industry or nascent property type from an institutional real estate perspective. But there are a number of players now who are building very large portfolios of scale and are capitalizing on this strong demand for single-family housing. So certainly demographics underpin our strong weight within those types of real estate portfolios and issuers.
Right. So Ken, where are people migrating from and where are they migrating to?
They're migrating from the cold states to the warm states. You take a look at Texas just picked up 2 House seats. Florida picked up a House seat. Utah picked up a House seat. I think that was because of LDS, but one of the Carolinas, North Carolina picked up a House seat. What's happening? It's kind of a multifaceted story. Look, but let's talk about Generation Y millennials for a second, because what they did, what Generation Y millennials did, was they extended adolescence to up to 30, and they were welcomed into the labor force late because their parents, the baby boomers, didn't exit it because they didn't want to or need to or whatever reason they did. But now these kids are 18 years old to 37 years old, and they need to live somewhere. We just did an extensive research project for and I can't tell you who for, but a large company in Massachusetts that wanted to be on the leading edge of multifamily housing for the Generation Y millennials. And one of the factors that came up repeatedly was the fact that so many millennials have student loan debt that they've got to get rid of first. So it's going to be a little while before they get into residential. But as soon as they get married and have kids, like Kate said, where do you think they're going to live? They're going to want to live in a house, and they're going to move out into the suburbs, just like the baby boomers did, because all the baby boomers, everybody thought that the baby boomers were going to live in the cities forever. No, as soon as they had their second kid and they couldn't educate him in a city, they moved out. Mm-hmm. So it's multifamily housing for Generation Y is a huge story, huge story.
Okay, so let's go, just because time's tight, and I didn't know that I was supposed to click the Q&A button. I was wondering where all the questions were. So we're going to do rapid response here. So Jack, you're real good with your questions there. Let's just see. How will the government replace gasoline tax in the future, Jim? Unmute.
I think still with consumption taxes, but yeah. Well, you want rapid answer?
That's a quick one. Yeah. Harvey asked the question: will downtown office towers come back? Is there a preference in commercial real estate, such as industrial versus multi-residential versus office, Kate?
Great. Well, certainly multifamily residential and industrial. When we talked about real estate transaction volume, those are the sought after property types. That's where we see the strongest investor demand, and that's where we've seen the greatest amount of cap rate compression. Now, given that, that's where we have had the bulk of our holdings. In terms of office, we are actually starting to see a resumption in private market trades for office, and surprisingly, a number of the trades, especially here local in Toronto, have actually come in at very favorable valuations in line with pre-COVID levels, and actually have provided a very strong read-throughs for value in the public issuers. And we do have very strong exposure within our portfolio with one specific office name who has a significant presence in both Toronto and Montreal. So we are certainly seeing a resumption in transaction value at shockingly strong pricing for office. So encouraging signs there.
Right. So Nick, for Kate, does this commercial real estate include residential apartment buildings in the GTA? And do you see these investments increasing?
Yeah, so we have very strong positions within GTA apartment issuers today. We talked a little bit about occupancy recovery within multi-res. Certainly, as people go back to the office, they go back to the post-secondary. We see a continuation or a step up in immigration. We do think that will bolster occupancy levels, particularly within the urban apartments, including in Toronto, and with tighter occupancy or higher occupancy levels, that should in turn bolster rate, which in turn bolsters capital value. So we've seen strong appreciation within the asset class, and we expect there's more to come.
Okay, so question for Nick with a spin. Question from Leslie. As a result of COVID, governments have been spending a lot of money. What threat, if any, does this debt represent for markets? And I've heard your comment that there's great fear that interest rates are going to go up. Can you put that spin on things, please?
Yeah, so our view is it's ultimately supportive. Now, I know it's scary that governments have, quite frankly, heinous amounts of debt and continue to rack it up. But what that does as an investor is it gives you confidence that while rates may back up a little here, they can't really back up too far. Otherwise, the central bank will be bankrupting its own government.
Right.
And so from that point of view, as an investor, you can look out on a medium-term time horizon and say, you know, interest rates are between 1 and 3. And if they go over 3, then you don't want to be invested in anything. And so we just think it lowers the probability of rates going up too far. So what now? Yes, we're backing up, but where we're going to end up in the long run is still very low rates, and that's ultimately very supportive of investing in particularly equities.
Okay, quick one for Kate. Where do you see cap rates trending as interest rates rise?
Well, prevailing cap rates, if we're talking about the Canadian market, are just around 6%. So we're seeing just shy of, or about a 400 basis point spread between prevailing cap rates and 10-year bond yields. Historically, that spread has been much narrower than it is today. Back in the mid-2000s or about 2007, it was about a 200 basis point spread. If we back up to the 90s, again, a 200 basis point spread. So there is a fair amount of cushion embedded in prevailing cap rates to allow for some interest rate increases. But importantly, interest rates are a factor in cap rate, but there are a whole host of other factors which actually have, in our view, a much greater degree of influence over cap rates than rising interest rates will.
Right. So Nick, how should portfolios adjust their asset and sector allocations in light of risk, higher inflation, central bank triggered recession, and the war in the Ukraine?
Okay, well, that's a long list. So, ultimately, I'd put it a different way. There are times to be taking risk and times to be not taking risk. We've just been through a period of a really great period for risk taking. You know, funds were up, market was up over 20% last year, 40% the year before, or 20% the year before. Our funds have been up a lot over the last 5 years. And right now, it's probably just not a time for taking too much risk. So you should dial risk down just for a little while. And as I discussed at the start. And so from that point of view, what I would strongly encourage you not to do is try and move from one place to the next, to the next, to the next, because what will end up happening is you'll just end up going to the next place that people end up selling.
Right.
And
I
so
heard,
it's just a simple case. Sorry, Bob. Yeah.
So I was going to say that I heard that what's your equity exposure right now?
Look, it's about 60%. So we've got about 40% in cash at the moment. And, we're really excited to use that cash at some point because we're getting some really, really good opportunities here. And that's going to set us up for the next couple of years, hopefully. But from that point of view, I just can't tell you when is the time to use that cash. We'll know a lot more after tonight. But I would just argue, I just point to people just to say, look, don't try and move the things around. Just take a little bit less risk for a little while and wait for everything to calm down. The sun will shine again. It always does. And sometimes you just got to recognize it's raining. So just stay indoors for a while.
That's it. Quick question from Mark for Jim. Tax rates, personal tax rates are well above 50%. Are they going to boost HST rates?
Well, I think ultimately that's probably going to be one of the most likely tool to actually deal with deficits would be increased consumption taxes, as I indicated. That's the HST in this country. And how much? I don't know. It has room to go up without, serious impacts probably on the economy. And if they went too high, they'd kill the golden goose. But that's not, I don't think, on the radar screen in the near term. I do not hear anything about it, but I believe that ultimately that'll be the tool that they look to.
Okay, Judy's question for you, Jim, real quick, is taxation of principal residence going to happen?
Probably not. Too politically volatile in this country. That seems to be a sacred cow, and I don't think the government's ever seriously looked at completely taking it away. If they did, it would be targeted at just very high-end homes.
Right. So we've run a little bit over time. If we can maybe have you for another 5 minutes, we'll get what we can through here. Nick, PE multiples. Some experts say that PEs are likely going to fall as interest rates rise.
So that's definitely started happening already. The question is do you believe that rates go back to where they were before?
Mhm.
And we don't think they do. Why? Because there's too much debt. So you can't physically get rates back to where they were before without causing much bigger issues. So if rates don't go back to where they were before, then everybody on this call still has the same problem they had before rates went up, which is that investing money in cash is not necessarily going to get them a great return. They're looking for a better return, and that will ultimately drive them towards equities, real estate, etc. And so from that point of view, PE multiples can come back, yes, but I just don't think they come back to where they were before. I think they sit at a high range.
Yeah, I heard you say earlier this week that was that one thing that you watch is earnings yields versus bond yields, right?
Yep.
And if we look back at fourth quarter, it was 18, right? That we saw that spread really tightened in. How does that look right now? Do we have enough incentive for people to own stocks?
Yeah, so we call it the equity risk premium, and so it's the earnings yield minus the 10-year bond yield. And so your close your eye and buy level is 6%, i.e. you're getting a 6% carry for owning equities, and right now we're still below 4. So what would help is if the 10-year bond stopped going up, and obviously a little bit of time will obviously make that equation get wider, but that is you close your eyes. Like that was the COVID level to buy, and that was the GFC level to buy.
Yep.
This is nowhere near as bad as that. This is a simple correction in a bull market in a growing economy. It's just going to be a little bit bigger correction than the ones we're used to last year. So I'm not 100% sure where the level is, but I'll know it when I see it, because stocks won't go down on good results. And you know that things aren't good when stocks go down on good results. And so you just got to sometimes just got to be patient and just recognize that it's going to take a little while longer.
Yep. So it's not panic time.
Definitely not panic time. No, this is a wonderful opportunity. And you just, like I said, the pendulum went too far this way. It'll come back this way. It'll set up some great opportunities for us to set ourselves up for the next couple of years. And it shouldn't be panic time unless the Federal Reserve decides to drive us all off a cliff, which I think is highly, highly, highly unlikely.
Right. So Ken, you caught Nick's attention on the eyeglasses question. So Jerry has a question, which is, what current industry is ripe to be disrupted over the next 5 to 10 years with a demographic spin?
Toys.
Toys.
Yeah, well, anything for young kids. Mattel's business is down about 10%, and they can't figure out why, but the number of kids under 10 is down 10% also. So we have a huge crop between 18 and 37 and up to 17 years old. We don't in the United States. Schools are going to shrink. Colleges are going to shrink. Food service to those particular institutions are going to shrink. Yes, those categories. But I'll tell you one other thing that I want to just plug in. Manufacturing is coming back to North America, and the reason it's coming back is because China, with their one-child-only policy, has effectively eliminated their labor advantage, and it's over. It was called a demographic dividend, and it's over. So manufacturing is coming back. Everybody I talked to 400 manufacturers yesterday in the food service industry, and they said they're having a problem finding real estate to build because they want to build the factories here. They want to manufacture the stuff here in North America.
Mm-hmm. Okay, so just for the sake of time, I'm going to turn it over to Paul Tyers just to close the evening.
Well, I think it's been a great evening, and I really want to thank everybody on behalf of Wealth Stewards, panelists, and attendees. We want to tell you that this roundtable has been recorded, and each of you will be sent a link that you can listen to again and/or pass along to an interested friend. I think around our own home, this will be some dinner conversation for the next short while. We do a lot of these webinars, some live like tonight, and some recorded and posted on our due diligence library. We believe, and quite frankly, some of this is really the knock-on effect of COVID. We've become a lot better in doing more of these online sessions. We believe that although many of you want us to manage your portfolios and do your financial planning, there are others who like to hear directly from portfolio managers and specialists that we use so that they can understand the investment concepts and get regular updates. And we've heard from Nick and we've heard from Kate this evening, whose firms we work with directly in our portfolio management. We're currently planning our next roundtable, and it's going to be called the Real Estate Summit. It will take place mid-March, and it'll focus on how to use real estate investments to grow your portfolio or to generate income without the hassles of changing the taps or fixing the roofs or furnaces yourself. Again, we plan to be hosted by some specialists, a roundtable of industry specialists, people who understand the multi-residential area, mortgage investing, and even something different, like investing in Ontario farmland. We're going to keep the lines open for a few minutes, so you can reach out to us if there are further details you require for this evening. We want to thank you again for coming and have a pleasant evening.
Right, and
Bye
Paul,
for now.
just to throw one other thing is we will take the questions that are posted here and we will work, sorry, we got through most of them, but we didn't get to all of them. We'll look at the ones that we didn't get to and we'll endeavor to get you a response fairly shortly. So, again, Paul and I appreciate everybody's time coming out this evening, and thank you very much to our panelists. We like the roundtable thing. I think it's a little more engaging, and we appreciate that you've spent time with us this evening, and we hope to see you soon.